Ryan Corcoran is the founder and CEO of Specialized Property Group, SPG, a real estate investment company that focuses primarily on multifamily investment properties. As a physician's assistant for his W 2 and through his real estate investments, Ryan has combined his passion for helping others as a medical provider and the ability to positively impact communities. He currently owns, either solely or with partners, 157 units throughout Massachusetts, New Hampshire, and Rhode Island, with 60 more units under contract. And at 27 years old, he no longer relies on his W 2 income to maintain his lifestyle. Ryan, welcome to the show.
Tim, thanks for having me, man. I appreciate it. I'm looking forward to this.
Yeah, and so I'm really glad to have you here. I give everyone a high level overview of your background, but on this show, we really try to dig deep into the journey into multifamily real estate. So if you could please talk a little bit about how you got started in real estate and then multifamily more specifically.
Yeah, sure. So I've always, since I started real estate, it was multifamily. And so when I started at 22 years old, the thought process back then was, all right, I am in my undergraduate program. I'm going to be graduating and I'm going to be going to get my master's degree as a physician assistant. So I was in like that bridge area where I was about to graduate undergrad. I had about a year between that and going to get my master's. And so I was like, well, what am I going to do? I don't want to live at home the rest of my life. I don't want to rent. Like, what are the other options? And so I stumbled across outpacking. So the idea was was going to buy a property, live in it, and rent the other unit out. I ended up finding a duplex, bought the duplex. I borrowed $10,000 from my parents. I borrowed money from my uncle. I had like $5,000 for my name. I bought the duplex. I fixed up one of the units. And then instead of moving into it, I decided I was actually going to rent it out. And so I bought this duplex for like just north of $100,000. And so it was making like $600-700 a month from the cash flow. And I thought like, okay, like I'm onto something here. Right. So I'm still living in my parents' house. And so I had this duplex. And then a year later, I ended up selling it. And so I walked away with this like check that was going to equal pretty much the same amount of money that I would make as a PA when I was done school. And so again, I was like, all right, I'm onto something here. So then I did that again about 3 family. This time I actually lived in the 3 family. So we house hacked in there. And then I sold that again, walked away with another check. I'm like, okay, I think this is where my journey is going to lead me. But I still went to school and I ended up finishing my graduate program. I worked as a PA for 2 years, full time, and I was buying multifamily property that whole time. But instead of 2, 3, I transitioned to 5, 6, 10, 18. We did a 66 unit, right? So bigger and bigger and bigger. And then actually, beginning of this year, January, I stepped away from my W-2. So I actually haven't worked at W-2 in the last almost 8 months now. And I've been doing real estate full time. And at the end of this month, we're in August right now, we'll be up to 231 units across New Hampshire, Mass, and Rhode Island. And most of those I own 50-50 with a partner, some of them a little less, and then some of them I own by myself. And then over the last few months, we've incorporated wholesaling and flipping branch onto Specialized Property Group, and as well as a development branch. So we sort of mastered the multifamily. We're still doing that, but it's on autopilot. And now we've got the flipping and wholesaling side. We've got a development side that we're about to jump into.
Wow. Okay. So much to dig into there. So, obviously pretty young when you started multifamily, but you started the way a lot of people do, which is house hacking almost, it sounds like the first time, which nothing wrong with that. If you can, live at the parents' house, while getting, that cash flow from that duplex for sure. You talked about the triplex that you did finally do, a real house hack on. How long did you own that triplex? Because it sounded like you went through the first duplex pretty quickly before you turned that around. What about the triplex?
Yeah. So the duplex, I had it for about a year and a half. The triplex, my wife and I lived in it, I think, for 6 months. We took some time I think it was like 9 months. Like it was a pretty short turnaround, but again, we had to put some rehab into it. And so that really forced the appreciation. But while we were living there, we saved like $35,000, like 6 months of living in it. And so at that point, we were like, okay, we've saved up enough now where we can go put a down payment on a single family house. Um, we've also built up enough equity in here where we could either do a capped out refi, and take it and go buy another one, or we could sell it and take it to another one. We ultimately ended up, obviously selling it. And then we ended up buying a single family, but that three family really like that, the chunk of money that I got out of that really propelled me in my business because I bought three more properties with that same amount of money than I did to buy that one just from the appreciation and forced appreciation that we were able to pull out of it when we sold it. So yeah, we ended up moving into a single family, and then from there we bought a 10 unit right after that, a 5 unit, and a 9 unit, all with that same down payment money. So we scaled pretty quickly from there.
That's okay. So what kind of appreciation did you see on that triplex
Sure.
that it was able to create
Yeah.
so much
Okay.
capital?
Yeah. Good question. First of all, I did buy it on market. So I bought this brick family for 200 grand off market. And so I was sending letters out to people, and these three families were going for 325, 330 grand as they were. And I bought the stick for 200. And so I already had 100 grand in equity right there. We put probably 10 grand, 15 grand in fixing up one unit, raised the rents in the other two units. We lived there for a while. Fortunately, the market was going up at that time. But even if it wasn't going up, we still had enough space in there. We could sell and pull out, pull out with equity. But it's so close to 400, right? So we were able to pull out, I don't know, I forget what the number was, over 125, over 130 grand. We took that, we were able to buy, with a partner, those other three properties. So
And so what I guess I'm wondering, since you held it for such a short period of time, if you got like hit pretty hard with like short-term capital gains.
absolutely. Yeah.
Okay.
100%. I think we had to pay like 25 grand or something like that in short-term capital gains. With that was a lot of money because we had just started working. So we didn't have like a real big savings. And so it was really a shock actually that we had to write a check for that much. But now looking back, you know, I pay way more taxes now, but I understand it, right? Like I'm doing a lot more volume now and a lot more sales and making a lot more money than I was back then. And I'm paying like, honestly, I'm not paying a whole hell of a lot more right now than I was back then. But absolutely got hammered with the short-term capital gain of that.
Okay. Yeah, I just wanted to make sure I checked in case you had any secret loophole that
No,
I was
no.
just yeah, because I actually had a triplex too. I held on to it for a couple of years though, before I decided to sell. I didn't make out nearly as well as you did, but it was time to transition out of that because I was self-managing as
Yep.
well and just needed to move on. And like you, I took the cash that I got from that and invested it into my commercial multifamily business
Yep.
by selling those small
That's exactly
multifamily.
what I did. Yeah. And I don't like people hear, okay, 130, like how can you go buy three properties that are 5, 6 and a 9 unit or I'm sorry, 10, 5 and a 9 unit right after that with that money. Um, you have to remember that my market may be a little bit different than yours. Prices may be a little bit cheaper. But the other thing is I also pulled in a partner. And we were also raising money. And so I was using a lot of creative financing to maximize that $130,000 to get me as much as I possibly could. And I still do those strategies today. We'll talk about it later with creative finance, but I don't use a whole hell of a lot of my own money still to this day to buy properties. And I'm a huge proponent of if you're trying to grow a business, like look at all the major businesses, Amazon, Walmart, Google, Apple, they're not using their own capital for the majority of the time. They're raising money. They're pulling out a fund or debt or giving equity away to, they're scaling their businesses, right? Real estate's so different. And so that's how I started, and I'm still growing that way today. So
No, that's awesome. You're right, and we will get into that a little bit more. But I wanted to find out how you're sourcing these deals. How are you finding them, especially at such significant discounts
yeah,
compared to what you would otherwise?
yeah. The name of the game for me is off market. So, and that can be a bunch of different branches. First and foremost, the most prominent and successful way that I have found to find off market deals consistently is through direct mail. And so I've got a system down. I've got a VA who runs the whole thing for me. I hired a company out in Lawrence. They basically, literally everything is outsourced now. When I was starting, I was like writing the letters out by hand. Like when I bought that three family, I literally wrote the thing out by hand. My hand was like falling on, but now everything's outsourced, right? So I have a VA doing all that. I've got a company sending the letters. I have a Google Voice number that takes all the calls. Um, and so that's pretty automated. And I sent out quite a few of those. And so I'm able to pull anywhere from, 1 to 5 deals a month on just direct mail. Now, whether I'm buying all those or I'm flipping them or wholesaling them, different story. Um, but so far, that's sort of what I've seen. And then I also have a cold calling branch. So I have a VA who's also doing cold calling. And then the last piece of it is every week I try to reach out to a handful of agents that I've never spoken to before. And I'm making a big, I just have this major list of agents. And then every other month or so, I send an email out and saying, hey, keep me posted. This is what I'm looking for. If you come across anything, let me know. And, I would say that at least last year, almost half the deals I bought were from agent referrals, about deals they just heard of or deals that were not yet marketed. Somebody said, somebody came to them and said, hey, I've got a 10-unit property I'm thinking about selling. They would immediately think of me because I'm always on the top of their head and I'm being persistent and continuously bugging them. And so between those three lead generation sources, I've been able to accumulate quite a bit of leads. And from there, it's just a matter of, is the deal good enough for you to buy? If it's not, somebody else buy it. So
Yeah, and in terms of the way you're sourcing these deals, cold calling, mailing, and you mentioned that you have a VA doing that, which is smart. I guess I would ask, so what is your target? Is it the smaller commercial multifamily, like the 10 to 20, 10, 20 to 50? What are you
sure.
guys targeting?
Okay. So this is important. So in the Northeast, now, so you're in Tampa, right? So in Tampa and in Florida, the composition of the real estate down there, there's a lot of properties that are like 100 units and larger down there, right? If you try to find a 100-unit property in the Northeast, like it's going to be very slim, right? So a lot of the investors up here go south or Midwest or somewhere else in the country if they want to find the 60 unit, 70 unit, 300-unit properties. Those just simply don't exist in the Northeast. And so there's a lot of duplexes, a lot of triplexes, a lot of five families, and then there's a lot of the like middle ground. So 12-unit properties that are kind of hacked up, but there's 12 units in it, 15 units, a couple buildings on one lot, right? And so, and I think they did that up here when they were building them because there's a lot of mills up here, and they were trying to squeeze as many workers in as they could. But that presents a good opportunity for investors who are trying to hit that middle ground. And so I've had a lot of success in the 8 to 20. I'm doing 230 units right now, a 36 and a 32 unit, right? But there's not that much competition for those units. And so when I'm sending letters to those people or cold calling them, a lot of them have never heard from somebody trying to direct to seller market them. And so a lot of times I'm the first one, and that presents a good opportunity for me coming in, and I can, sort of manipulate this conversation and try to create a win-win for both people. But really, I just know the competition. Now that has changed over the last couple of years, but yeah. So between that 8 to like 30, even up to like 60 unit range, just a lot of the big guys aren't doing that, and a lot of the small guys can't touch it. And so this recommend.
Yeah, no, that makes sense. It's that nice middle ground between, really small people just starting out and the institutional or bigger
Correct.
players. Now, are most of those mom and pop that you're reaching out to? Is that what you find?
Most of them are mom and pop. Maybe they own a couple properties. I'm trying to think if I bought a property from somebody. I've never purchased a property from somebody who owns like hundreds and hundreds of units. I've had more success. Um, you know, maybe somebody owns we bought a couple of properties last year from a guy who owned 27 units. And that was probably one of the larger landlords that we bought properties from. And we just bought them all from him. And I was actually the first person ever reached out to him with a letter. And so, yeah, you never know. That's why I think direct mail is great because you're putting the ball in the seller's court, right? So you're acquiring, and if they're calling you back, they're calling you back for a reason, right? Most of the time, it's I've thought about selling. What's the number you want? Sometimes it's hey, screw you, stop sending me letters. But other times it's okay. They're genuinely calling you back because they might be interested in selling. And so at that point, you've now created a relationship with a potential lead and a potential person or a seller. It may not happen right away, but maybe a year from now, you'd be on top of their head to to sell it. Maybe 3 years from now, they might look to sell then and they'll remember you. And so that's why I love direct mail. It creates a longer impression, than just a random cold call or just, from an agent, a lead from an agent. Um, and so, but yeah, I've had a lot of success doing direct mail, at least up here in the Northeast.
Yeah, and I think the important thing that you hit on is that you see this as a long game. This is not a, I expect to get this person to sell to me the first time I contact
Yeah.
them. It's building that relationship, chipping away,
Yeah.
because they may not be at the right time, space.
It's all timing. It's all timing, right? Like there have been many times where the first letter I send, I buy that property, but more often than not, like 1% of the letters people call you back, they're interested in selling it out, right? But a year from now, they'll remember you, keep sending them letters. And it's not about just like sending them once. It's every couple of months, you're hitting the same group of people over and over and over. And I don't know whether you just keep beating them down until they have to call you back, or whether it's just, you get that letter at the right time, and they called you back at that certain time in their life. Maybe something happened. Maybe a family member passed away, or maybe they inherited the property, or they're sick of dealing with tenants. Who knows, right? But timing of that letter is huge. And so that's why you have to stay consistent over and over again, because eventually it will work. It's funny. I talk to people all the time. It's like, well, if I sent 5,000 letters, I might not get a phone call back. Okay. But if you sent 50,000 letters, do you think you're not going to get a phone call back? Like, absolutely not. Right. And if you sent, 60,000 letters, you think you're not going to get a deal out of 60,000, you're 100% you're going to get a deal, but it's just consistency. You have to stay consistent with it.
Yeah. And so something that I've seen, like with people trying to pitch me personally is the text messages. Is that something that you're using as well, or have you not done that yet?
I tried it. And again, so I really believe that everything works. Direct mail, cold calling, texting, direct email, whatever it is, whatever you decide to do, you have to, again, consistently do it. And so I tried text messaging one time. I didn't get anything out of it. And I wasn't persistent with it. So of course that hasn't worked for me yet, right? But I guarantee you, if I did SMS over and over and over and over again for months, I would 100% land it. I haven't done that yet. It's on my list of things to do. But yeah, I think that's a good, that's a perfect example, right? I tried it once. Oh, it didn't work out. Just gonna forget it. I'm never going to do it again. SMS doesn't work. No, of course it works, right? And I haven't, it hasn't worked for me personally because I tried it one time. But if I did it 50 times, I guarantee you it would work. And so I think that's the summary of direct to seller. No matter what you do, you're going to get discouraged at first, but you gotta keep it rolling.
Yeah. And I think it's funny because it's like I was inclined to respond to the text message because it's right there in front of me on my phone and I'm so used to texting, and that's probably largely a demographic thing, right? If I'm 65 years old, maybe I don't even look at that thing and I'm much more comfortable on the phone, or whatever
Yeah.
the case may be. So all right, now say you get these leads now and you lock them up. How are you financing? Because I used to live in the Northeast. I'm originally from Jersey. And I know the prices can be a lot higher. So when I hear like even 20 unit in the Northeast, to me, that sounds really, really expensive. But I'm sure that's not always the case, especially depending on the condition. But what, what is the price range that you're looking at on, most of these, whether it's per door or total,
Yeah.
and then how are you financed?
So it's hard to answer the first part of that question because, it's all relative, right? So, about a property in Bristol, Rhode Island, where I paid 122,500 for a door. And then I bought a property in Laconia, New Hampshire for 60,000 a door. Right. And so they're two states apart. Okay. And so, but to be honest with you, they produce pretty much the same cash on cash return. And so it's really hard to say like, this is the price per unit I'm looking for. This is how much it should cost. It really dependent on the area, what the rents are in that area, and what the market rate is in that area, and then getting a discount. And so I got the markets that I focus on down to a T. However, it's always changing, right? So the interest rates just went up, right? And so you think I can buy that property in Bristol for 122,000 now? Probably not, because my rate's going to be higher, which my debt service is higher. And unless rents go up like $100 a month, $100 a month per unit, I like to make that number work, right? So you're always juggling it and trying to figure out where you need to be. I'm sorry. And what was the second portion of that question? How to create financing. Okay. So
Yeah.
All right. So once you've got a property under agreement, you know it's a good price, you've got a deal. Okay. Creative financing is probably the second most important thing any investor needs to learn how to do. The first one being find the deal. The second one, how do you put this deal together? So the first thing that I think of is, okay, I'm going to go to a conventional lender and get the cheapest debt over the longest term that I possibly can, at a maximum LT, right? So 70, 75, 80, whatever it is that they allow. Then it's okay. So now let's say I have to put like three or $400,000 down for a down payment. If you don't have that money, or even if you do have that money, I strongly urge you to think of other ways to be creative here. So this is where hard money, private money, seller credits, seller financing, all these creative options come into play. And I've used pretty much every single one of them, and I've combined almost all of them together as well. And so it's really important when you're starting and you have the money to be able to put deals together, have the creativity to structure deals, put them together. Otherwise, you'll never get off the ground. And I just want to give you an example. The first 10 unit I bought after the three family. So I was using my own money to buy the three family. But then when we got to the 10 unit, instead of out of 130 grand, that 10 unit was 750K. So if you do the math, we need like almost 200 grand as a down payment, right? So obviously I didn't have that. And so I went out and raised the down payment of that from a private money investor. And I promised him 10% interest only payments for 12 months. And then when we refinance that property, I'd pay him back off. And I was using my capital, my partner's capital to do the recap. And so we went to a lender. We showed him the deal. He approved us for 75%. So that 25 came from somebody else. So I just closed on the property with none of my own money into it yet, aside from an appraisal and an inspection, stuff like that. Then we started doing rehab. We refinanced, we paid off the lender, and then we owned 10 years, right? So that's one example of how you can structure. Another way is hard money. So instead of even going to a conventional lender, you can just go to a hard money lender immediately. Points are higher, interest rates are much higher. It's expensive to use hard money, but they can close relatively quickly. They sometimes finance the recap for you. And so I use this on a lot of my flips actually. We just bought one and closed in 4 days. He closed a $500,000 property in 4 days. It's like 8% interest only payments, and they funded the entire recap for us. So you just have to be creative, and try to plug and play different methods and merge them together to make deals work.
Yeah, and that's really the value that you're adding. I want to emphasize that for folks who are just starting out, think they can't do this because they don't have any money. But that's really the value that you're bringing. It's not necessarily money, it's the time that you put into finding the ways to put the deal together, bringing all
Right.
those pieces into play in order to make it work. No, that makes a lot of sense. And so now I'm just curious on some of the specifics. The 10 unit, how were you able to pay for the renovations or the rehab on that one? Was that rolled into the loan from the bank, or did you get that from the private investor?
So the private investor was with the down payment. And then if you remember, I had sold that three family and I also brought a partner in. And so between my partner and we split the rehab costs. It didn't need all that much rehab. I think we put a total of 50 grand in, so 25 a piece. And then when we refinanced it, it was worth almost $1 million. Actually, it's worth just over $1 million. And so we were able to pull out all of our initial down payment, not all of the rehab, but all the initial down payment. We paid the private money lender off. And then actually we had another deal in the pipeline, and he immediately lent us on that one. And so we've actually been using that private lender he's probably done 10 deals for us, between me and my partner. With just the 50/50 deals, he's probably financed 10 deals for us. I think treat your lenders well, and you give them good returns, and make sure you buy really good deals. They typically come back to you.
Yeah, I think that's right. It's perform, right?
Yep.
If you can prove that you can perform, and it's no different like in my case where I'm focused mostly on syndications, you know, raising money from passive investors, that's what they're looking for. Can you perform? Are you going to get me the returns that you said you were going to get me? Are you giving me distributions? And then if you do, it may take a few years for those deals to go full cycle, but if it does and you've been communicative and you've gotten them the returns you said you would, they're probably going to reinvest with you and might even tell a friend. So,
Yeah. I want to stress something real quick because I think, for anybody new here listening, it's how can I raise $200,000? Like, who the heck am I going to get money from? Right. And so what you don't have a track record and you have no experience, but you understand the concept, like you've read some books, you understand. Um, some advice is don't try to go out and just attract, don't go try to talk to real estate investors and say, hey, will you invest in me? The most personally, what I did was I went to family, friends, friends of friends. I went to coworkers. I went to people who I personally knew who necessarily wouldn't care too much about the actual deal. They more cared about me as a person. And because I'm a good person, I'm a man of my word. I do what I'm going to say. Um, I was able to raise capital early on in my career, not based on the actual deal, right? And so a lot of private money that what I got when I started, unlike in a syndication, like typically in a syndication, people want, and you could probably speak on this. I'm doing one syndication right now, and it's a lot of, okay, what's the return going to be? What's the terms? When am I going to get what's the exit strategy? All that kind of stuff, right? And so, but when you're raising private money for whether it flips, burrs, equity part, whatever it is, if they trust you as the operator, you will have a lot more success raising money and getting yourself off the ground, not really dependent on the deal. And I think that's really huge for people starting off because, when you don't have a track record, how can you say I've done X amount of deals? Sure, it helps, but when you're starting off, you don't have that. And so definitely go to the people you know already. And believe it or not, a lot of people have, even if it's a couple $1,000s lying around, that can help you get off the ground. And that was a huge stepping stone for me once I wrap my head around, hey, mom, dad, hey, my sister, my uncles, my friends, my coworkers, I was really able to pool some money together to start buying properties that I otherwise wouldn't be able to buy. So
Yep, that's key. Go into your inner circle first, because when it comes right down to it, the number one rule is people invest with those that they know, like, and trust. And
correct.
who knows, likes, and trusts you more than your immediate
Yeah, your immediate
well,
circle.
friends and family. And I would say even with like passive investors, you're right. They do, go down that list to say, what are these returns? What is that? But like, to be honest, I think that is really just kind of a check the block thing.
Yeah.
And that they're just trying to verify that you know what you're talking about, but it still comes down to the know, like, and trust thing.
Yeah,
If they
absolutely.
think anything is off about you, it doesn't matter how good the returns are, they're not going to invest with you.
Yeah.
So yeah, some things change, but a lot of things stay the same,
Yeah.
regardless of what type of deal it is.
It's funny. We just raised $300,000 in a debt position as a soft second loan. Okay. And so for what people listening to that, so that essentially means that that loan I'm personally securing, but there is no collateral to the property, like whatsoever. Like, so this guy is literally just investing $300,000 in me personally. Now I could go do whatever I need to do with that money, whether it's, I could buy a boat with it, right? But the point is, if you become known as a good person, if it's somebody that's trustworthy, people will start to look at you differently and they will say, okay, I will trust this guy with that, a large sum of money, to make me money. Now I'm buying a property with that, of course, obviously, but, again, he has no collateral. So if I flunk on it, he doesn't even he doesn't have the property out of it. So I think that's important. Yeah. It's just reiterating, you know, people will trust you. Get around the people who, first of all, get around people who know what they're doing and who, people doing what you want to do. You'll meet people. That's the whole story for another day. But yeah, again, friends, family, coworkers, people who have money to start, who know you as a person, is definitely the way to go to begin.
Yeah, and so you talked about most of these properties you owning outright. Um, I guess I would ask, like, that obviously takes a lot of capital, but that's between you and your partner putting in your own capital, to own that, vice a syndication type model, correct?
Yes, but I really am not putting my own capital in. So, like I was saying, I'm raising money to do the down payment. It's sometimes, actually, the majority of the time, we're raising money to do the rehab as well, depending on how good the deal is. And then we use as complete appraisals. That there's a whole, like, we call it, like, an advanced BRRRR. Essentially, you get as complete appraisal at the beginning, and you know what the property is going to be worth when you're done. When the rents are completed, so you know what the value is going to be. So you already know when you refinance a property, how much money you're going to be able to get back. And so from that point, we can literally raise debt to that point, knowing that when we refi, we'll be able to kick back that money. And if it's too close, then we'll start inputting some of our own money to ensure that if any money is left in the deal, it's our own and not an investor.
Now, are you holding most of those long term? Like, are
Yeah,
refinancing the money
yeah,
out?
exactly. Exactly. So yeah, Burr model has been the way we've done it so far. Um, I think I've only sold up the long-term holds. I'm selling that first 9 unit that I bought in a 5 unit. Other than that, I haven't sold any of them. I've just been hanging on to them. And when I first started, I had this idea that I'm never going to sell any properties. I'm just going to accumulate this massive portfolio. It's unrealistic because first of all, you run out of money. and number two, unit count doesn't mean anything, right? It's all about like the bottom number, kind of lifestyle do you want? And so I ended up starting a flipping company and a wholesaling company to generate a lot more revenue where I could dump into longer term rentals. And so that's how my brain worked and how the picture of what I wanted my business to look like. So instead of selling some of those properties to recoup money, I just started another branch that would start generating capital so I could use it back in.
Okay, interesting. So yeah, so that's like a hybrid model where you're using the flipping for income,
Yeah,
immediate income, so that you can put towards the more long-term wealth building
correct.
side of the business.
Yeah, because I watched my net worth over the course of 2 years skyrocket from where I was. But I wasn't, as you know, like cash flow is like it's great. It allows you to keep properties. It allows you to hold them long term while it's being paid down and while appreciation is happening. But like, I personally don't believe you can get rich off of just the cash flow. Like it's very difficult because no roof might go. That's $20,000. That could be your whole year of profit, right? And so found it hard to rely on cash flow. And so that's why I said, okay, I'm not going to go full blown this major flipping company yet, but this year we'll probably do 20 flips. Right. And so that's plenty of capital to number one, live off of, do whatever the heck I want to do on, but also have enough reserve to manage these multis and buy more properties with. So yeah, that's what the model looks like right now. And then of course we added a development piece onto it, but that was like a loop that came out of nowhere that I'm actually very interested in growing that further. Again, a conversation for another time, but yeah, so that's what the business looks like today. And it's going well. I think we'll see what happens with the market and where things go. And my big thing is I'm always willing to pivot, right? So the last like month, I pumped the brakes on direct mail to larger multifamily because I wanted to just wait and see what was going to happen. And now I'm starting to hammer it again because I see deals popping up, like lower priced properties popping up. And so I am in there trying to scoop them even lower than they are. Yeah. And so I'm always trying to pivot around and you know, try to find a way to capitalize on whatever's going on.
Yeah, and it sounds like as you saying that what I'm thinking, the other advantage that you have to that hybrid approach is that it would be beneficial from a tax perspective as well, because at this point you could identify yourself as a real estate professional, I would
Absolutely.
imagine, and so you're able to somewhat mitigate the tax implications of those flips by using the longer term
A
holds.
100%. And then this year, and I'm not a tax expert by any means, so don't take my advice, right? But I've done 6 cost segregation studies I just have to pay for them. I have it in front of me. And so I can see how much my tax liability is going to be. And basically, by being a real estate professional, all that flipping income that I can make, the majority of it is actually going to be paid down from the cost deck at the end of the year. And so all that depreciation that is advanced for, I'm sorry, whatever prorated advanced depreciation is going to pay down most of the income that it paid. And so that's why I said, when I put that 3 family, I paid 25 grand. From a relative standpoint now, flipping 20 properties a year, the ratio is much, much smaller now because I've got the multifamily area where I can cost segregation studies, depreciation, and I can write things up, right? That I wasn't able to do before.
Yeah, no, that's awesome. And the other thing that I was curious about, the financing on those longer term holds, I'm assuming that's like traditional. Is that 30-year fixed, or
Yeah.
what are you doing there?
Yeah. So when you force appreciation by increasing rents and doing rehab and really improving the value of the property, after you pay that debt partner off when you do the refi, you're now stuck in a 25 to 30-year AM with these interest rate, it's just long-term debt, right? But at that point, I either own it solely, I own it with a partner, maybe a couple of partners, whatever the structure is. But we don't have any second term debt on it from an investor anymore. And now we own the property as if we put the down payment down ourselves.
Yeah,
So
and there's a lot of peace of mind there too, right? As
Yeah,
rate go crazy up and down, you don't have to worry about that because you're in it for the long term.
exactly, exactly.
Oh, well, obviously we could talk about this all day, but we're gonna have to move on and go into the turbo round. So now I'm gonna ask you three quick questions, and I need you to give me your best response. So the first one is, what is one red flag every investor should look out for, be it a passive investor, active investor?
I kind of touched up on this a little bit. So I'm going to twist it a little bit. So a red flag to me would be having like the sort of the shiny object syndrome. And what I mean by that is basically multifamily, single family flip, syndication, it could be wholesaling, right? There's a bunch of ways to do well in real estate, and all of them work. The red flag in my mind is you can't focus on all of them. Like you can understand all of them, but you absolutely have to pick one of them and dive very, very deep into that one before you can start doing other things. Otherwise, you're just going to be grasping the surface on all of them and you will never advance far enough. And so red flag to me is when you see people saying that, they're, I don't know, they're doing all these different things. I just be careful with that. Maybe they are, and maybe they mastered them all and now they're able to add more branches on. But I really think you should focus on one thing, master it, build the full bridge, have it running, and then you can start doing other things.
Yeah, I agree. It's hard to be an expert in all things. I'd wager to say impossible. So that's a good red flag for both investors as well as those active folks as they're diving into this. Hey, a little self-awareness goes a long way. If you find yourself starting to get that shiny object syndrome,
Right.
pull back.
Yeah,
Find
reel yourself back in. Yes.
Yeah, exactly. All right. Now, what is a myth about this business that you would like to set straight?
Okay. This one for me is you do need money to invest in real estate. I don't hate when people say you don't need money because let's just rephrase it. Like, I had no money. I had $5,000, right? Most people have $5,000. I had no, and maybe they don't, but I could have done it with $0 technically. But you need money to invest in real estate. The biggest thing I want people to understand is that it doesn't always have to be 100% of your own money. And so, yes, you need a lot of money to buy real estate, millions and millions of dollars to buy real estate, but it doesn't always have to be yours. And so once you can wrap your head around that fully, you're able to start being creative. And we talked about it earlier. But don't get roped into the, I don't need money to buy real estate. You actually do. You need a lot of it. Just remember that it doesn't always have to be yours. It can be a combination of yours. It may be $0 of your own money, and it may be all investors. It's totally dependent on the deal and how creative you can structure things.
Yeah, it's so important. It's like it's the nuance, right? Like, can you do it with zero money down? Yes, but ...
Yeah, exactly.
All right. And the last question is, what does success look like to you?
Okay, so success to me is always evolving and changing. So when I first started, it was, I just want to buy a property, right? I'm going to be loaded. I'm going to have this duplex and tribe. I'm going to be done, right? Absolutely not. But you get to that point, you feel a little bit of success, but then it's on to the next thing. Like, what's the next goal? What's the next level? And so at one point it was, I don't want to work my job anymore. I need to replace my income. What do I need to do? And so once I achieved that, next is, okay, I need to turn this into an actual sustained business. And then once it got to that, it was, how do I take it to like the actual next level where I've got a couple different businesses, I completely step away from it. And so the next level of success for me is where I am pretty much stepped away. I think I'm a little bit away from that just because I'm trying to build a few branches here. But yeah, success to me is loving your life, being around your family, being able to do what you want to do, when you want to do it, with who you want to do it, wherever you want, and having everything function in the background. And so, yeah, to me, success is, I would say that I've already hit all the success levels that I wanted to hit, but there's always more, right? You always have more. There's always another one. And that's just part of being an entrepreneur. You're never truly fully satisfied with where you're at because you always want to get that next level. And I think that's part of, being an entrepreneur and especially in real estate, there's always something else and it drives us forward. And if we didn't have that, we would be entrepreneurs, right? And so, with that said, it is important to slow down, look back and say, where have I come? Try not to compare yourself to everybody all the time, but it is very difficult to do that. This is a loaded question, but hopefully that was a good enough answer for you. But yeah, it's tough. It's a tough question.
Yeah, exactly. And I think that's that delicate balance, right? Where it's continuous growth, which is what a lot of entrepreneurs look at. Like, yeah, I hit this, now I need to hit that. But at the same time, having that gratitude, taking that time, like you said, to step back and appreciate what
Yeah.
you've accomplished, who you have around you.
Yeah.
Um,
I'll tell you, man, I have, and you've experienced it, I guarantee it. And most entrepreneurs I know have experienced this. You will have the highest highs ever in your life. You could higher than any drug or anything could ever do for you, right? In entrepreneurial world, but you will have the lowest lows. And it is a roller coaster ride. But it's all worth it in the end. but yeah, success is always changing.
Absolutely. Well, hey, Ryan, this has been great. I really appreciate you coming on. If you could please tell our guests how they can get a hold of you and if you have anything else that you'd like to share with them.
Yeah. So I started a YouTube channel at Ryan Corcoran. I have an Instagram at rjcorcoran08. I started a TikTok channel. I'm really trying to start putting out social media and content because I've seen how a lot of other, you know, guys in our space have really elevated their business doing that. So if you guys could go give it a follow, give it a like, I'll follow you back. Reach out to me. We can chat. But yeah, that's the plan moving forward.
Yeah, same here. And I just got on TikTok, but I warn people that it is cringeworthy at best.
Oh yeah,
But but you learn as you go, right?
exactly.
So I'll definitely be following you. Hey, again, you have packed a tremendous amount of value into this show. You brought a slightly different perspective than some of the like syndicators that we have on. So I think a lot of folks are going to appreciate that. Thanks again for coming on and have a great day.
Yeah, man. Thanks for having me. I appreciate it. Take care.
All right, bye.